Have you ever seen a stock chart that just seems to break the laws of physics? One that doesn't climb, it just launches straight up? Well, these aren't your typical everyday market moves. This is something else entirely. So let's get right into it and break down the wild tactics behind these absolutely explosive parabolic moves.
Okay, just look at this. Seriously, this is a chart of Avis. In a single morning, the stock went from about $180 all the way up to over $545. That is not a gradual rise, that's a rocket ship. What you're looking at here is a total and complete detachment from reality, from any kind of fundamental value. So the big question is, how on earth is a move like this even possible?
There's actually a name for this craziness. It's called parabolic momentum. And it's basically what happens when the balance between supply and demand gets so out of whack that the price just goes vertical. It's pure market mechanics, and honestly, it often has very little to do with what the company is actually worth.
Right, so to really get how this works, we've got to pop the hood and look at the engine. Let's dig into the anatomy of a short squeeze, because that is the machine that powers these unbelievable vertical moves.
And here it is. This diagram shows you the engine behind all that chaos. It's called the squeeze loop. And you need to understand, this is not a rational, logical process. No way. It is a completely irrational feedback loop where the price of a stock disconnects from reality and starts creating its own insane momentum.
So let me walk you through it. Step 1, the price starts to tick up, just enough to light the fuse. Step 2, this starts to trap all the people who bet against the stock. We call them short sellers, and for them, panic starts to set in. This leads to step 3, forced buying. Those trapped traders have to buy shares to get out of their losing positions, which, you guessed it, just pushes the price even higher. Step 4, now everyone else sees the move and gets a massive case of FOMO, the fear of missing out. They start piling in. And that brings us to step 5, the feedback loop. More buying, higher prices, more panic, more FOMO, and the whole thing just feeds on itself.
And here's a fantastic way to understand why the market is so prone to this. The entire system basically has a long bias. It's kind of like a guitar that's built for a right-handed player. Sure, a lefty can play it, but it's awkward. The market is just fundamentally set up to make it easier and less risky to be a buyer than a seller. And that built-in bias is like pouring gasoline on the fire during one of these squeezes.
Okay, so if the squeeze is the engine, what's the fuel? Well, traders who look for these opportunities are hunting for a very specific set of ingredients, the stuff that creates the perfect storm for this kind of insane volatility.
They're typically scanning for 4 key things. First up, a low float. That just means there's a really limited supply of shares out there to trade. Second, they look at recent IPOs. Because these new stocks don't have a long price history, there's no established resistance. Third is a weird one. Reverse splits. This is when a company artificially reduces its number of shares, which can create a real powder keg of low supply. And finally, you have sympathy plays. This is when one stock in a sector goes crazy and it pulls all the other similar stocks up with it.
But you gotta understand, not all of these big moves are created equal. You have a type A move, which is driven by real valid news, like a huge earnings beat. The volatility there kind of makes sense. But the real trap is the type B move, also known as the mystery move. There's no news, no reason, the stock is just spiking. And that makes it an incredibly high-risk gamble that can fall apart in a split second.
All right, we've seen the exciting part, the allure. Now we absolutely have to talk about the danger. Because behind these incredible charts, there are hidden risks that can, and do, wipe out a person's entire account in minutes, sometimes even seconds. Let me tell you the cautionary tale of a stock called Dry Ships, ticker DRYS. This thing went from $4 to over $100. That's a 2,500% gain in 5 days. It was complete and utter irrationality, and by the time it all came crashing down, countless short sellers had been vaporized. Which brings me to one of the most important rules in trading. The market can stay irrational a lot longer than you can stay solvent.
Now this is one of the most terrifying things that can happen in trading. It's called a circuit breaker halt. The stock halts, trading is frozen, and you are trapped. You can't get out, you can't do anything. With Avis, the stock halted at $481, and when it reopened, just 10 seconds later, it was at $331, an instant $150 per share loss that you were powerless to stop. There's a reason they call this the Widowmaker.
And if that wasn't bad enough, there's a hidden cost. It's called the spread, the tiny difference between the buy price and the sell price. Now, on a normal, stable stock, that might be a few cents, no big deal. But on a crazy stock like Avis during its run, the spread was $5 to $7. Just think about that. You're instantly down $7 a share just for the privilege of getting into the trade.
And really, this all gets to the heart of the psychological trap, FOMO. You see the move start and you hesitate. Then, as it keeps ripping higher, you feel this deep regret. The market is literally designed to make you feel stupid for not being on board. So finally, you give in, you chase it, you buy near the top, and that's usually right before the panic selling starts and the floor falls out. It is a brutal, brutal emotional cycle.
So for this last part, I want to zoom out from the charts and just talk about the cold, hard reality of this arena. This is the final and most crucial word of caution.
You know, the reason these moves look so tempting from the outside is because of something called survivorship bias. We only hear the stories from the winners, right? The friend who made a fortune and bought a new car. But for every one of those stories, there are so many losers. And the losers, they're silent. You never ever hear from them.
So let's be crystal clear about this. Trading is extremely risky. Most beginner traders lose money. The charts we looked at, those are not typical results. And you should never, ever, ever trade with money that you cannot afford to lose. Period.
And that all leads to the final, most important takeaway of all. And I want you to think of this less as advice and more as a command. Before you even think about risking a single dollar of your real money in this high-stakes game, you have to answer one simple question. Can you prove that you can be profitable in a simulator first?